Hello, everybody. It's John Browning with the Building Your Life podcast. We're back once again today, and I know that those of you who are regular listeners have been waiting for this podcast. Frank, we've been talking about you over the past several weeks and about a way to create a dynamic asset rather than a static asset out of your home. Now, we've had mortgage brokers on the Building Your Life podcast before, but we have never had what you're going to talk about today and what a lot of Guardian Rock Wealth clients are using through you to, again, make their house a dynamic asset that creates financial flexibility for them and also can potentially help them pay off their house much, much faster than a conventional loan. So, Frank, nobody can do this better than you. I'm going to let you introduce yourself, what you do, and a little bit about how you do it. And then just got some questions because this is a complicated subject that really is difficult for people to get their minds around because nobody else does it. Right. So, who are you, Frank?
Well, thank you, John. Appreciate what you do. You do it better than most, maybe everybody in your field on your dynamic approach on the, not your father's financial advisor.
Yeah.
So with that being said, thank you again. I've been in the business 27 years. I worked for a large bank for 24 of those years. The last 3 years, I've been with the largest non-bank privately held mortgage company in the country. It's either the top one or two. CMG Home Loans. We're a 30 plus billion-dollar company. I've had a lot of fun over the last couple years wrapping my head around. We have over 1,000 products and programs, something for everybody. But what you alluded to was our all-in-one proprietary principal first mortgage. We've had it for 23 years. It's a constantly reducing risk product. Why? Because you're constantly reducing your principal balance. You're paying principal before interest. You mentioned complicated. It can be complicated until you do a visual or look at one of my videos on it. But where it's not so complicated, the reason why it's complicated, let me backtrack, is because it bucks, like you said, tradition. All we know is traditional mortgage banking, which means the bank holds your interest. The bank holds your deposits every month. Your paycheck comes into your traditional bank. No problem there. The bank takes that money, gives you nothing on that money, and holds it until you need to pay your bills. Normal banking 101 in this country. What do they do with your mortgage payment? Well, traditionally, your mortgage payment consists of principal, interest, taxes, and insurance. What do they also hold? They hold 1/12 of your escrows every month. So they hold our escrows, which means they're holding more of our money. We know nothing else. That's the way we bank here. Again, mortgage 101. But what they do with that money is nothing for us. They're lending our checking and savings and our escrows out to everybody else, including ourselves. They'll hold 1 million of their clients or all of their clients. They hold their money, lending it back out to the industry, making money on our money. What do they do with our escrows at the end of the year? They just pay them for us. So they babysit us on our escrows. So that's two ways they get us on our mortgage. What do they also do on our mortgage payment? Your mortgage payment, let's use $1 million mortgage, even if you're at 4% interest, it's calculated at $1 million over 30 years at 4%. Even if you only owe 20% or 20,000, excuse me, in year 29, it's still calculated at $1 million at that interest rate over 30 years. So it doesn't benefit us. It benefits them. Why? They front load the interest for 20 to 21 years. So they get us three different ways: holding our checking savings, hold our escrows, and front load our interest until we pay it off. What's the most important thing to you, John, in every one of your consumers prior to this call? What's the most important thing to you on a mortgage? When you go to a mortgage lender and you're shopping for a mortgage, purchase, refi, whatever it may be, what's the most important thing to you?
Everybody always looks at the interest rates, right? It's like, how
100%.
high is my interest rate? Yeah.
Who's got the next eighth better in rate? Well, we're all in the same arena there traditionally, but I get to rebut that. I have a product that negates interest rate. You can oftentimes pay less than 2% because you're paying principal before interest based upon your normal debit and income habits. The reason why it seems complicated is because it just flips the script on all we know.
Right. And I think that's what really, people don't believe it's true, right? It's like, how could anybody do that? And the truth is, none of the big traditional banks are likely to ever do this because they have an entire probably $1 trillion, well, definitely $1 trillion business if you count all the banks, that is built off charging all of us interest on our interest, so to speak, because we pay our interest, then we'll pay a tiny little bit of principal, and then we'll pay a big bunch of interest, and then a tiny little bit of principal. And during that time when that interest is building up during the month, we're paying interest on that interest. They don't want to stop that, but CMG has, because this is the way they started and built their business plan. This is the new product. Now, it isn't for everyone, though. We need to make that clear, I think, right up front. You do have to qualify. Tell us what some of the qualifications generally are.
Okay. You mentioned one thing, new product. It's not a new product. It's been around for 23 years. We did 2.5 billion in it last year. I assume we'll be 3 billion plus. Um, Qualification. There's no free lunch. We still have to traditionally qualify you based
Yeah.
upon normal Fannie Freddie guidelines. We follow suit of that. We don't put our clients in harm's way. We have quality control. What does that mean? It means that when we take the application and I educate you thoroughly on the product to determine if it's the right product for you, when I determine it is, we go through a Zoom call on a case by case basis and we show you the value. Sometimes we put your financial advisor, you, on the call and or their CPA to make sure we're doing what's best for the consumer. But back to traditional qualifying and then the quality control. We'll call you up front from the beginning, even after they've talked to me. It's a third party within the company, unrelated to me. It's in our all-in-one department. And then prior to closing, the final clear to close would be calling you again. They have quality control. Our department has quality control calls every month on the product to make sure it's performing. What it is it's a high performing product that brings high value to the consumer to build wealth through their mortgage. You've never heard that statement before. And also, what does it do for us as a company? It brings us, it's averse to risk. Why? Because it's a constantly reducing risk product because you're taking advantage of your money based upon your normal debit and income habits instead of the bank controlling it for you.
Right. I think the key thing is this is a product that fits those who are high earners. They're generally high performers, high earners, high assets, who have traditionally, maybe it used to be when they were first starting out, right? They didn't have that high income. So they may not have qualified for this, in which case you would just work with them to do a regular mortgage, right? But if they've been successful, successful executive, somebody who has done well and been responsible with their money, and they've got a credit score, what, in the high 700s? Is that basically what you're looking for
Actually, I
this
believe
product?
it depends on loan to value. We'll go up to 90% on that product.
Mm-hmm.
Depending on, you can 700 is fine, 720 is fine. I believe we'll go to 680 on it, depending on loan to value. So I think we're pretty generous on it.
Okay, so that's even better than I thought. So a lot of people can qualify for this, or they can have assets, right? That would be the other thing.
Absolutely, that's a good point. And I'll get to the assets in a second. But you mentioned who is it for, who is it not for? I think you answered the question. I'll just parlay off of the high net worth. It tends to be that for me, dealing with the CPAs and the financial advisors, but it doesn't have to be. It could be your first time home buyer. You just have to basically have who is it not for? Well, who is it for? It's for people that handle their finances. You had already said this, in a responsible manner and aren't heading in the wrong direction with their life finances. Who is it not for? The reverse of that. Pretty simple and dry, but pretty cut and dry. But you mentioned also the assets. Yes, I've had many situations to where we'll have income here. They don't quite qualify for the debt to income ratios, but I'll dig a little deeper and ask them about their asset picture. If they have assets, I can do asset-based lending. I don't touch their assets. I don't do any redirect their assets. I just simply take their asset total and divide it by 10 years, 120 months. It gives them extra income towards qualification because we know they have the ability to pay if they needed to or ran into a jam. That's
Mhm.
asset-based lending. Or I could do, they could have no income other than a lot of assets. I could asset-based and qualify them off of that. It's a good tool.
It's a good tool. And I think the tool, because you know me, one of my one-liners is use the tool that we call money to build your best life. That's one of my one-liners that people are getting to know me by my one-liners. But it really is a tool that not many people know about, and even fewer use because they start to overthink it. I think that's the issue, is they begin to overthink it. But let's just really quickly here talk about how we could use this in a tool as a tool in the wealth management overall plan. And the big, enormous difference that there is between the all-in-one mortgage versus a typical traditional mortgage that most of us think about. So the way that this works, and correct me if I'm wrong, is that the best way, I should say that the best way for it to work, I know some of my clients use it this way, others use it a little bit differently, but the best way is they will set up, all in one will set up, CMG all in one, your servicer will set up a regular checking account for the individual along with the mortgage account. You do everything like you normally do. You don't have to change your current banking situation, but you could. And you have your paycheck, your social security check, your annuity check, whatever income you have goes into that checking account and can immediately be transferred to pay down the principal all throughout the month of your mortgage. And you're paying every time that principal goes down, you're paying less interest. Am I right so far?
You are. So basically, we're taking simple example. We're taking $1 million loan. Traditionally, your $1 million loan is $1 million amortized at the interest rate over the 30 years. I alluded to that earlier. In our case, so the bank front loads the interest, being repetitive. In our case, we have our mortgage tied to your banking, federally regulated bank account. Your money's coming into your banking like it does every day or whenever you get your deposits. What does it do? At 11:59, we're not holding your money every night. By midnight, it sweeps through, reducing your principal first. Why is that huge? Because you're holding your own money. You still have 100% access via an ATM, Venmo, Zelle, credit card, check writing, wiring ability. You have your normal banking. It is your holding tank, we'll call it, by reducing your principal first. You're not paying the bank the upfront interest. It's effectively bringing down your true interest rate. I've had people as low as 0.5%. I've had people as high as 3.5%, but it sure is better than current mortgage rates in mid sixes. Or I've taken people off of refinances that had less than 3% interest. Why, John? Because do you want to pay 3% based upon your never changing start loan amount amortized over 30 years for the next 26 years because they had that interest rate during COVID? Or do you want to pay it off based upon your same debit and income habits, base nightly simple interest on your constantly reducing loan balance? Again, what's more important to you, interest rate or the amount of interest dollars you pay and paying off your loan? Well, nobody's been asked that question before.
Yeah. And I think so. The first question then, but Frank, then when I pay extra on my mortgage, it's locked up. I can't get access to it because it's in my house. But the truth is, I'll let
With
you
the
answer that question.
all-in-one, you have your ATM. Sure, you're going to have your maxes on your ATM. They're not going to let you draw 200 grand of your cash equity. Remember, John, there's a difference between equity on your normal mortgage, which changes microscopically, right? On an average home, if you're at 6.5% interest, nobody realizes right now 6.5% interest would be a great rate. 6.25. Let's call it 6.25. You're paying 162% interest compared to principal over the life of your loan.
Right.
You're
Right.
paying greater than 1.5 times of your house. But on that same all-in-one, based upon my client I just ran a scenario for, they're paying, their effective interest rate is 1.95% interest, and they're paying less than 40% interest over the life of the loan. They're paying almost 1/4 of the interest.
I think people don't realize this, right? When you've paid even 6%, but you've paid it in a traditional mortgage over, say, 30 years, or even, oh, I paid it off a little bit early. I paid it off in 15 years. Even if you paid it off in half the amount of time, by the time you paid that kind of interest, you've paid more than 100% of the house. So you buy $1 million house, you've paid $2 million principal and interest. But with the all in one product, that gets reduced substantially. I mean, less than half.
Let me add one more thing to it. Even if you're at 3%, and I've had this, I probably took 20 people off of sub 3% interest rates this year. I'm at 3%, Frank. I'll never touch that. I'll stay on it for the life of forever, for the next 26 years, because I got it during COVID. Well, you realize even at 3%, you're still paying about 54% interest compared to principal over the life of the loan. So do
Mm-hmm.
you want to pay 3%, 2 7/8 on your start loan amount of $1 million amortized at 30 years for the next 26 years, or have it paid off on an average of 7 to 9 years based upon your same debit and income habits?
Yeah. And I think, I want to hammer home again what we were just talking about is, yeah, you got your ATM, you could withdraw, let's say you needed $500, you can withdraw that from this account. It goes back on the principal amount. And so you have to pay interest on that, but you can just pay it back or use it as you normally would. But the whole point is you're taking your entire paycheck or your entire Social Security, whatever, and as you need it, you're still paying your bills out just like you would throughout the month. And you're using that, basically the equity in your house plus your income, you're all using that together. You're putting the puzzle pieces together to create your best life, right? You no longer have a house that's a static asset that you cannot take down to the grocery store if you needed to and buy a loaf of bread, and changing it into an actual asset that you could take your debit card, your all-in-one debit card, take it down to the grocery store, buy a steak with it if you needed to do that, if you got in a jam. Or say you didn't get in a jam, everything's going great and you're a businessman. And I've had this happen. Business people really like this product because they can take their house, put it in an all in one, get it paid down quicker, pay less interest. And then, oh my goodness, I see an opportunity to invest in my business. It would take me 30, 60, 90 days at a traditional bank to get the financing for it. Instead, I can just write a check out of my all in one and then worry about the financing it through my business later, but immediately get access to those funds if they're available on your all in one.
You're doing it anyway. They're still using their debit and income or their credit. They're still taking their money out of their Bank of America account to do the same thing while Bank of America's holding your money. You're doing nothing different. You're holding your own money. When you're paying your bills, don't pay the car payment that's due on the 8th. Don't pay it on the 3rd. You auto debit it right out of your all-in-one mortgage banking on the 8th. Why? Because you got extra days of nightly reduced principal balance. Then you pay your bills on your mortgage payment. Your mortgage payment's not due on the 1st. The traditional bank doesn't care if you paid on the 1st, the 10th, the 12th, as long as you paid before the 16th, because they have a fixed set payment because it's front loaded in interest. On our product, we only take the interest that's accumulated the month before, but it's due on the 21st. What does that do? It gives you 20 extra days of you holding your own money by reducing your principal.
Well, here's another question. So I run into a really bad month. Something really bad happens. I get sick. Something happens, right? I lose my job for a few months, and I don't have any income. So I have to miss a payment. I don't really miss a payment, right?
You do not miss a payment. The only thing that's required to come out is the interest payment that's accrued the month before. On a traditional mortgage, what happens if that occurs and you're struggling on your mortgage payment? Remember, the bank's not waiting for you to get another job. They're knocking
Right.
on your door. They're calling you 20 times a week to tell you, hey, you missed your payment. We're gonna foreclose on you. In our scenario, you've negated the principal that you're giving on a traditional mortgage, which means you've negated the principal, the majority of the principal, by paying the principal first. The majority of the interest, you've negated the interest by paying the principal first. So now that you pay the principal, what do? And then we've had this happen before. Our quality control reaches out to them and they basically, uh, looking for a job, no problem. At that point in time, what do you have? You have financial flexibility through your equity, which is not just equity, it is cash equity. It is your savings account. It is your checking account. It gives you financial options. You alluded to earlier, that is a distress situation,
Right.
which very distressed in a traditional mortgage. You don't have a lot of options.
Right.
You alluded to earlier on that cash equity also, what could you do if my effective interest rate, a lot of my clients, savvy, your clients, our clients, what do? Well, they realize they're not paying the upfront interest. Well, gee, if my effective interest rate on this product on my debit and income habits is 1.9%, and now I have $300,000 cash equity, whereas my traditional mortgage would have only had 25 equity, you don't have any access to that traditional.
Right.
What do? Call up your financial advisor, John Browning, and see, John, can you make me better than 2% on my money if I were to wire some money over to you? If they didn't like the trajectory of the market 3, 4, 5 months later, what do? Call John. John's like, I need 48 hours to liquidate. Liquidate it, comes through. You just paid off and down your mortgage again.
Right.
Financial flexibility.
That's exactly right. There's several different ways we just discussed how this creates optionality or financial flexibility for you. And while this is not financial advice, never is on the Building Your Life podcast, but what we do is we give you options, we give you ideas. We certainly wouldn't suggest that we could ever guarantee anything in terms of your returns. However, if you believe that, generally speaking, even in say treasury bonds, you're generally going to be able to do better than what your actual interest rate is on the all-in-one. That might be an option for you, especially if you're a little bit younger or something like this. But one of the things that I tell everyone, and sometimes people disagree, or sometimes it's just this issue, right? And I get that. You want to pay your house down, this is a great tool to do it. You can pay your house off, no problem. But that's logically, logically speaking, frankly, never paying your house off is a pretty good idea because it's an appreciating asset 9 times out of 10. If you look at any 5 year period, it goes up
Ultimately,
in value.
yes. Historically.
And in addition to that, it's one of your lowest interest rates, certainly of anything I know of, that you would take out a loan on. So paying that off and decreasing your optionality, having just this static asset that you can't gain access to, you can't go out and sell your house in a day. You certainly can't. You may be able to sell it in a week if you sell it at a fire sale price. You don't have to do that. The only disadvantage to not paying your house off is you do have to carry insurance on it, and some people don't like paying the very high the insurance rates. But frankly, I suggest that most people have insurance on their house anyway. There's really no reason to have a house with no mortgage, except for if it just personally in your heart makes you feel better, but logically, mathematically, and from a financial point of view, there's really no reason to pay your house off or just sit in a paid off house. It's not serving you other than that roof over your head.
Well, back to the financial flexibility part, parlaying off what you just mentioned. If you want to pay off your mortgage in 6.9 years, remember, it varies for everybody. If you want to pay off your mortgage 6.9 years, so be it. That's your choice. You still have 100% access to that cash equity, like we talked about. But another thing, if you don't want to pay it off, that's your choice. You have financial flexibility, only product that exists that gives you financial flexibility through your mortgage. Another thing, as interest rates come down, you never have to refinance this product. Why? Because your monthly payment's always decreasing. Again, it's based upon your nightly simple interest on your constantly reducing balance. Who wouldn't love to have their mortgage payment decreasing as their cash equity is increasing and their balance is also decreasing? But last thing on that point is, as interest rates come down, you don't have to refinance, which costs you money and recast the term. Banks love it. I made a good living off refinancing people over and over again because that's all we know. Here, you never have to refinance. You get the automatic benefit, potentially monthly, of the reducing loan rate. Huge.
And if interest rates go up, which they may over the course of time, you still paid down the principal of your mortgage so much faster that it's going to have less of an effect as if you were than if you were in a traditional mortgage.
It's going to have pretty much zero effect, which I can go through anybody's particular situation by asking them 7 questions, which we won't get to now, or we don't have to.
Right.
I can run them the scenario and show them that scenario you just brought up, or that point.
All right. Well, we'll wrap this up, but the best way to get in touch with you, Frank, is, and we're going to put it down in the show notes, as well as we're going to put the link to your video in the show notes as well, so people can go see that. But what's the best way to get in touch with you?
Cell number 240-401-1333 or FTRIMBOLI F Trimboli at CMG homeloans.com. So F Trimboli at CMGhomeloans.com, and you'll have it below.
Yep, we'll have it down below in there, as well as how to get in touch with me. And those of you who are regular listeners know that you can get in touch with me at guardianrockwealth.com, or you can grab that cell phone, open up the texting app, and text 321-421-5213 and text the word life. You will get one text. You won't get 50 texts. You'll get one text with all kinds of free information, as well as a way to contact me if you are looking for non-traditional, thinking outside of the box wealth management advice for today's marketplace. So, Frank, thanks so much for taking the time and explaining this to us a little bit. I know some people are confused. They're going to want to reach out and talk to you. Sure. So I hope your phone starts ringing off the hook for that.
I appreciate you, John. I really do. It's a lot of fun. We're truly bringing value. I can speak for you. I've had a lot of experience with you and done a lot of business over the last couple of years, and I greatly appreciate you and what you do for your clients and clients in general. And we're here to help. Whatever's best for the clients is where where our goals are.
Right. We make money either way. Both Frank and I are gonna make money. We got to put food on our tables, but we work our businesses in such a way that we don't have conflicts of interest. It really doesn't matter to us what product you use. It matters to us because we want you to use the right product for you.
Absolutely.
So that's it, everybody. We'll see you again in a couple of weeks on the Building Your Life podcast. Thanks for tuning in.
Thank you, John.